There's always a recession somewhere in the US economy. Like in the last 5 years, I might even say 20% of parts of the US economy have been in a recession. So that's why we call it a rolling recession. And the trade war is probably creating another set of rolling recessions. Now that doesn't mean the overall economy is in a recession, because GDP could just grow slowly as parts of the economy are in recession. So people can't say they know anything with certainty.
Yeah.
But in 2022, we had a series of rolling recessions that have continued, so for 3 years now. And in 2022, the S&P was down 27%, and earnings didn't recover until the second half of 2023. Investors at that time claimed the market was going to have more downside because they thought the rolling recessions and the Fed tightening was going to lead to a bigger economic decline. We had argued strongly against that. We said that credit, the debt levels of consumers was too low to prevent a larger recession. Today, the same conditions are true.
Financial analyst and Bitcoin optimist Tom Lee notes that while recession fears are at an all-time high, the market is telling a different story. He recently shared his perspective on the current economic uncertainty, highlighting how tariffs and recession worries are fueling market volatility. Lee believes a major market rally is imminent, and that's where Bitcoin comes into play. Lately, Bitcoin has been behaving more like a risk asset, meaning if the broader market recovers, Bitcoin is likely to surge alongside it. However, the key factor is uncertainty. If the market remains stuck in limbo, Bitcoin could face short-term pressure. Currently, Bitcoin's price sits just above $14,000, having gained over 23% in the past month. Lee also points out that markets tend to bottom before major events are fully resolved, so a sharp recovery could be just around the corner. The bottom line? Bitcoin's next big move depends on how these economic factors unfold. Let's dive into the latest interview with Tom Lee as he shares his market outlook for the coming days and weeks.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
So the question I think we're all trying to debate is, if we have a trade war recession, so trade is slowing, is that enough to create an overall recession in the economy? Because we know it's creating a trade recession. There's always a recession somewhere in the US economy.
Sure.
Like in the last 5 years, I might even say 20% of parts of the US economy have been in a recession. Okay. So that's why we call it a rolling recession. And the trade war is probably creating another set of rolling recessions. Now that doesn't mean the overall economy is in a recession, because GDP could just grow slowly as parts of the economy are in recession. I'll give you an example. Housing has been in a recession for 3 years now. And since 1900, prior to this period, whenever housing was in a recession, the overall economy was in a recession. But we've had a housing recession for 3 years and the US economy has been fine. And I don't have an answer to that, but the one market I'm watching is the high yield market. If high yield spreads, which means high yield rates relative to risk-free rates, if that reaches 1,000 basis points, then we're almost guaranteed a recession. But it's currently at 367 basis points. So to me, the high yield market is saying we have another rolling recession happening, not a US recession. So that's why I was asking you to clarify, because I think it's going to be too easy for people to say, oh, GM's in a recession, so the economy's in a recession. GM could go into a depression and it probably wouldn't affect the US economy. But we don't want too many parts of the economy to go into a recession, because then that would drag the overall economy into a recession. But historically, it's required what you call a shock. So for instance, if oil prices spike to $300 a barrel would cause oil to be 15% of US spending. that is a shock because it's currently $50. But oil has to go up a lot. But in the past, that's caused a recession. The second type of recession is a financial system shock, like 2008. So if the financial system, the banks or credit has a crisis, then that pulls all the sectors of the economy into a recession.
Right.
But if manufacturing's in a recession or housing, it doesn't create enough ripples. Just keep in mind that in 2023, when the regional banks got into trouble, many people predicted a depression because they said, oh, the regional banks are going to be the firewall, and if they fail, all credit fails. But we had a regional bank crisis and the economy was fine. But in 2022, we had a series of rolling recessions that have continued, so for 3 years now. And in 2022, the S&P was down 27%, and earnings didn't recover until the second half of 2023. Investors at that time claimed the market was going to have more downside because of they thought the rolling recessions and the Fed tightening was going to lead to a bigger economic decline. We had argued strongly against that. We said that credit, the debt levels of consumers was too low to prevent a larger recession. Today, the same conditions are true. Businesses and consumers aren't highly levered. So there is risk of job loss coming, and that's why we could have a recession. But for someone to be so confident that we're going to have a recession, I think they're dead wrong. Sure. And by the way, that's what you're hearing. I think a lot of economists are declaring recession. In my 30 years, I've never seen an economist get the recession right. So the fact that many are claiming there's a recession probably tells me the odds are very low of a recession.
The ongoing adoption of Bitcoin by governments, institutions, and the media reflects a growing recognition of its value. However, Tom Lee emphasizes that this is just the beginning. Comparing Bitcoin's early years to today's widespread interest and investment, especially with the spotlight on Bitcoin ETFs, he highlights this as a pivotal development in the financial ecosystem. With unwavering enthusiasm for the Bitcoin space, Lee confidently predicts explosive growth on the horizon as major players like BlackRock and other crypto giants continue to enter the market. He assures that a long-anticipated surge is coming. By the end of 2025, there are expected to be 1.1 billion active crypto wallets. The pace of this growth is staggering and will represent the fastest accumulation of wealth ever witnessed. This conclusion comes from a career's worth of research, with every chart and study pointing to the same truth. Liquidity drives everything, and crypto is set to be the best-performing asset of all.
We're in the final phase of this bull run. Let me guide you. We've launched Daily Dose Crypto Alpha, a free private Telegram group just for the Daily Dose Crypto family. Inside, I'll guide you through profit-taking strategies, real trading tactics, long-term crypto investing mindset. Only 500 spaces available, then it's closed. If you're serious about this bull run, click the private link to join now.
But this is why I think markets recovered so quickly. I think investors made a few mistakes. The first was they were betting on the end of U.S. exceptionalism, that their view was with DeepSeek and the tariff wars, that the rest of the world would start to be a better place to invest. But keep in mind, if you look at the 25 largest stocks in the world, 21 are U.S. companies, only 4 are non-U.S. And here's the question, do we really think that the tariff wars, maybe monetary policy, are enough to unseat the U.S. center of innovation? That's not our view. The second is many thought the U.S. was going to slip into a recession, so they sold U.S. stocks. But as you know, we've talked about this, the high yield market did not confirm that. The high yield market, as you can see here, this is spreads, have been rallying. In fact, at the peak, high yield spreads only got to 461 basis points wide to treasuries. Here's some perspective. If you look at the last 15 years, high yield spreads have gotten even wider than that. And even when the Fed was doing the fastest rate cycles in history, the widest it ever got was to 599 wide. And again, that's why we did not say there was a recession risk, because that's not really a recession level widening. And in the post-tariff liberation day carnage, spreads only got to 461 wide. In fact, as you know, many economists have now canceled their recession call. Like, for instance, JP Morgan just this past week said there's no more recession risk. The third is that people said the supply chain was going to take a hit, so they want to short US stocks. Well, we've talked about this too, that look, let's say container bookings are taking the shape. These are ships leaving from China to the US and they collapsed, but they're going to recover now that we have some tariff visibility. Markets are going to ignore that because that's a speed bump that works its way through the supply chain, similar to a government shutdown. And in fact, even though that's our view, hedge funds were shorting cyclicals and small caps, and they continue to short them even this past week. Well, guess what? Container bookings have exploded. So now that we have the tariff wars behind us, things are recovering. The fourth is that the VIX surged, and that forces institutions to de-risk. The top chart here is the VIX, and the bottom chart is speculative positioning that's non-commercial. Okay, that means, in other words, risk on. And as you can see, every time the VIX spiked, everyone is forced to de-risk. Well, guess what? When VIX starts to calm down, people re-risk, and that causes a rise in stocks. And I congratulate this. Retail investors were buying this dip, but hedge funds typically short what retail does. So you basically had retail buying while hedge funds were shorting retail actions. But guess what? Retail got it right. And of course, ultimately, this is a reminder, and we've said this before, there is a Trump put out there, and investors just forgot it. A lot of people said the Trump put didn't exist, but that's not true. So where does this lead us? I think the S&P is going to make its way to all-time highs and probably go higher. We cover that at FS Insight, our service for investors to follow our views. But again, we do think at least making it to the all-time highs is very likely. And that gets us back to the granny shot. So granny shot suffered during this black swan period, but as you can see, in April and May has begun to recover. In fact, it gained 771 basis points relative to the S&P since May 9th.
Historically, in the year following Bitcoin's halving and after reaching multiple all-time highs, financial analyst and Bitcoin advocate Tom Lee shares his forecast for investors. He predicts that an astonishing $400 trillion is poised to flow into Bitcoin. Lee also points out that established corporations like Apple, Amazon, and Google will leverage their decades-long relationships to quickly acquire significant amounts of Bitcoin through spot ETFs, bypassing the complex processes of buying the actual asset. This highlights the transformative impact cryptocurrencies are having on traditional financial institutions. Meanwhile, Michael Saylor emphasizes the urgent need to embrace digital currencies as the economic landscape shifts rapidly, urging investors to tap into Bitcoin's potential to secure a more prosperous financial future. What are your thoughts on Tom Lee's latest interview? How do you think Bitcoin's path in the coming months will influence the crypto market and the broader investment world? For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.